What is going on, everybody? In today's video, I'm going to be going over 5 different lies that I hear about FHA multifamily, about buying an apartment building with an FHA loan. And that's something that I did several years ago, so I have a lot of experience with that. So if you're looking to buy a multifamily property with FHA, watch this entire video. Okay, so the very first lie is that you can use any lender to do an FHA multifamily. And the thing with FHA is that every lender is going to have different requirements. You know, you look online, you know, sometimes it'll say minimum credit score 500, sometimes it'll say 580, sometimes it might say 600. Every lender is going to have their own specific requirements. And not only that, but some lenders might not even do 4 units, and they might not do FHA multifamily. So it's going to be lender to lender. Like overall, it should be relatively similar, but there's bigger banks versus local banks. They're going to have different restrictions and things they like to do. And not only that, but because with FHA multifamily, because you're buying an apartment building, you know, if you're looking to buy like a 4 unit, which I would recommend, unless you can find a great deal at a duplex, you want a lender that is local and responsive, because there's just more moving pieces with FHA multifamily. It's not the same as just buying your standard house. You might have to, you know, get more lease information. There's going to be more involvement with the lender. So you don't want to be using some lender that has like a 1-800 number in like, you know, some part of Arizona if you live on the East Coast. You want like Bill or Bob, the lender, or Sally, the lender, who's right down the street. You have their cell phone, you have their email, you can text them, you can call them. You need someone that can be flexible and work things out to get to closing on time. And of course, if you need a good lender for a multifamily FHA property, reach out to me. I can put you in touch with the guy that I used. The next lie that I hear is that PMI or mortgage insurance goes away. So one of the good things about FHA is you only have to put down 3.5%, so long as you have a, like, I think 580 or 600 credit score. So you only have to put down 3.5%. However, because you're only putting down such a small amount, it's a riskier loan for the lender. So in exchange for that, you have to pay mortgage insurance. So for me, my property that I bought a 4 unit in DC. It was I paid about $500K for it. So my mortgage insurance, it's a small percentage of the loan, but it comes out to about $350 every single month. And a lot of people think that that goes away. And if you only put down 3.5% and you're doing FHA, it will stay with you for the entire life of the loan, no matter how much equity you have or anything like that. My property right now, I have a ton of equity. So most times with most like conventional loans or other types of loans, anytime you're putting down less than 20%, the bank is going to require some private mortgage insurance. However, you can usually get that waived after you have about 20% equity in a property. But with FHA, even if you have 20% equity, you still have to pay this insurance premium unless you put down 10% as your down payment to begin with. And then if you put down 10% to begin with, the PMI only goes away after 11 years. I don't know, kind of random number. So it doesn't even matter. I have hundreds of thousands of equity in this one property, way more than 20%, but I'm going to be paying $350 per month, basically a car payment, a nice car payment, for the lifetime of the loan. Now, what some people do is they refinance into conventional, and then you can use the FHA again. So that's another myth, is that people think you can only use an FHA once. However, you should think of FHA like an eligibility. So you could own several properties, but if you haven't used your FHA yet, then you can use it even if you've bought a property before. And not only that, but one good strategy, you could basically take your FHA loan, buy a 4 unit apartment building, you know, live there for a year, which we'll talk about in a second. And then, you know, maybe you added some value, the values went up, hopefully, and you got a good deal from a motivated seller. Then you could refinance that into just a conventional rental property loan. And then you'd have that FHA availability again, or eligibility again, to use it on another property. And you could quickly, you know, over the course of 5 years or so, build up a pretty substantial portfolio doing that FHA strategy. Another lie that I hear is that people will just use FHA properties as basically rental properties from day one. And the requirements are you have to live, it has to be your intention to live in the property as your primary residence for at least 1 year. So you don't want to mess around with that. You can get into a lot of trouble by doing that. So make sure if you buy it, your intention is to live there for a year. A year goes by faster than you would think. So You know, if it's not in your favorite area, just live there for a year, save up some money, then you can move out to a different property. The next lie I hear is that people think FHA is only for like low income borrowers. And that's just incorrect. And I'll explain a little bit more. So with FHA, the criteria for an FHA loan is actually a lot less than most loans. So your credit score, you can actually have, I think, between a 500 and 580 credit score and still get approved for an FHA loan. Now, each lender is going to have their different requirements. And if your credit score is in that range, usually you're going to have to put down more than the standard 3.5%. Usually you're going to have to put down 10%. However, most lenders won't even let you get any type of loan with that type of credit score. So FHA is a little bit more flexible with that. And then, you know, your down payment requirements don't have to be as much either. So you only have to put down 3.5% so long as your credit score is like at least 600. However, you can also purchase, if you look up the FHA loan limits in different cities, in expensive cities like Washington, D.C., for example, where I'm at, the loan limits go up for the amount of units. So like a 2 unit, it might be like the highest amount an FHA loan would go might be like $1 million. And then 3 units, it's like 1.2. 4 units, it's like 1.8. So you can literally buy a $1.8 million property in Washington, D.C. You know, you still have to qualify for it with your income and everything like that. But you could get into some really high-end, expensive, probably historic real estate by doing that, and probably make a decent amount too. Just because someone that is going to be living in a $1.8 million property, if you have 3 other units, they are probably paying a significant amount towards your mortgage. And the way lenders calculate that is they will take 75% of the gross income of the current tenants in there, and they'll use 75% of that to help you qualify towards your mortgage. But obviously 1 unit has to be vacant because that has to be the unit, at least 1 unit. You can have multiple units vacant, but it's going to help if it's a 4 unit and 3 units are occupied and then 1 unit is vacant that you can move into. The next lie I hear is that people think the FHA is like incredibly strict. And they are stricter than a conventional loan most of the time. However, it doesn't mean the property has to be like fully renovated or anything like that. You can still buy value add FHA multifamily deals. Like the property I bought, it was in good condition, but you know, it was definitely not renovated, fully renovated or anything like that. FHA just mostly wants to see that there's nothing egregious. They don't want to see bars on the windows. They don't want to see mold. You need to have appliances. You can't have broken windows, broken roofs, anything that's like falling apart. So if you're gonna buy like a complete fixer-upper, it's probably not a good idea. You can buy a fixer-upper that's like livable, and maybe it's like some type of estate sale, but the appliances have to work. It has to be where a reasonable person could be like, yeah, someone could live there. Like it's not the most updated, but someone could live there. And those are really the best types of deals to buy because you can basically force the appreciation of the value. You don't have to rely on the neighborhood. And sometimes what the appraiser will do too is like they might find deficiencies, but that doesn't mean the deal is killed. That just means you have to fix that before closing. So I remember one deal where it was like it was a foreclosure and they were missing appliances or missing a refrigerator. So actually my buyer actually purchased a refrigerator, put it in the they were getting a great deal, so that it wasn't a big deal. But they had to buy a refrigerator and put it in the property so that we could close before closing. And sometimes the appraiser might say you have to take the bars off the windows, and then they'll have to go out there, make sure the bars are off the windows, make sure the gas stove is working, stuff like that. So you can still fix things before closing. It doesn't mean it's a deal breaker. So if you're looking to buy an apartment building using an FHA loan and having it be your primary residence, reach out to me. I'm in the Washington, D.C. market, but I have agents nationwide that can assist you. Or if you have any questions, drop them below. And I also have resources and a real estate investing community as well that we're working on that you can check out. There's lots of cool stuff in there, lots of resources, trainings, different things like that. So check that out, and I'll see you in the next video. Bye.